Hello and welcome to the Power of Passive Investing. We are thrilled today because we have not only an amazing guest, we have an amazing repeat guest. Jeremy has been our guest, I want to say a few years ago. He has a very impressive bio. I'm not going to read you the whole thing, but I'll just tell you that he's been a passive investor for over a decade now. He provides an education and has a very long following himself. And outside of real estate, he's also investing in other alternatives. He is also an advisor to Realty Mogul, which is one of the largest real estate crowdfunding platforms, and has a very impressive education with MBA from Wharton and a license as a real estate broker in California. Welcome, Jeremy. I'm sorry.
Oh, thank you. Thanks for having me. Thanks for everyone who's joining us.
Yeah, so today's session is not going to be a typical one where we usually have a presenter speak for like half an hour and then ask questions. Instead, we decided to make this interactive. We've prepared a number of questions for Jeremy, but also for anyone who is live with us, feel free to unmute yourself and ask a question, or if you prefer to post them in a Q&A, by all means, feel free to post it into Q&A, and I'll read the question for you. So let's dive right in. We are in the third month of 2024, and many investors are concerned. Is it going to be as bad as 2023? Is it going to be better? Jeremy, I realize you may not have a crystal ball, but what is your take on the state of the market this year?
Yeah. Thanks again for having me. So, of course, I don't know for sure. I'm one person's opinion, and I should tell everybody I'm not a financial advisor, an investment advisor, or anything. So, just my perspective as an investor. What I would say is that 2023 was kind of the year of increased interest rates, right? We had the interest rates max out at that point in mid 2023, and they've held steady since. And that's been impacting all different aspects of real estate and the economy, right? And it takes a long time for it to have its full impact. 2024, we're having kind of more of the impacts of that. And we are, in my opinion, 2024 could be a second domino, which could be a recession. And I'm sure we're going to get into that. But it's, in my opinion, the end of cycle really had two major dominoes to fall. One was the increase in interest rates, which are going to have all that impact that it's having now. And the second domino was eventually a recession, which is, in my opinion, still the most probable scenario. And that's typically what happens at the end of a cycle. And so if we assume that, then we still have to wait for that second domino to fall to see the real full impact and then get the full reset.
In terms of the second domino, do you think it's going to be intertwined with the presidential campaign?
It's very difficult to predict. So what's interesting is that a lot of people aren't aware of the fact there's been a lot of stimulus that's come from the government, even in 2023. And I'm not talking about the COVID stimulus, I'm talking about post-COVID stimulus. And so the question is, how much are they going to be able to push through this year? There's already been some proposals for child tax credits, for student loan forgiveness, all these other things. Make no mistake about it, that's all stimulus, right? It's extra money going into the pockets of people that wouldn't have had it otherwise. So the question is, will they be able to push that through and impact the economy this year or not? Will it have as much impact as it had last year? And, the jobs numbers, very interesting, which are very critical to the Fed right now. 70% of the official government statistic that goes into the labor market is actually a guess. It's modeled out. 30% is actual feedback from the actual employers. So the vast majority of that figure is actually a quote unquote guess. And if you take a look at what's happened in the last 1 to 2 years now, there's been constant revisions almost every month, reducing the number. So the ones that come out are more favorable. And so I don't know for a fact that they're juicing up the numbers on purpose, but it certainly seems like it, or they're doing a very poor job of actually estimating the numbers correctly, and they happen to always be more favorable. And so the question is, will those hold as well? Because on the one hand, that signals that the economy is supposedly going well. On the other hand, it actually keeps the Fed having rates raised for longer, which the longer the rates are raised, even going steady sideways like right now, the more impact it's going to have on the economy. So there's a lot to unpack for the elections. And of course, the elections are always very unpredictable. On I'm a little biased. I don't like politicians. I don't vote because of that. And so I have a strong opinion about there's a lot of manipulation, all the rest of it. But putting all that aside, it is very hard to visualize a recession during an election year because you would imagine they're going to do whatever they can to postpone it. So that being said, though, interesting statistics that I saw the other day. So the Philadelphia Fed releases its estimates of every state's economy every quarter. And the Q4 results recently came out. And interestingly, 22 states were in a recession in the US. Only New York, one of the larger states, was in a recession. Most of the other states were small. And that's actually why we have not a recession overall with states like California, others actually bringing it up. But historically, on average, once you get to 26 states in recession, your country's in recession, right? The US is in recession. So we're very close to that point potentially right now. And we'll have to see what happens here in the next few quarters. And don't forget, there was a lot of excess stimulus that the consumers spent last year that they're kind of wearing out now, and it's kind of mostly or fully gone, depending on the source you read. That will be a drag on 2024. So there's a lot of forces that are a drag on 2024. And if it wasn't an election year, I would think there's even a higher probability of a recession this year. So we're going to have to see what happens. It's very difficult to predict.
Yeah. Thank you for that, Jeremy. I completely agree with you that the year is going to be interesting and unpredictable because of the upcoming events. Nevertheless, since we have a recession in some of the states, do you expect to see some sort of distress? And if we do see a distress, do you think it will be directly correlated with the recessionary states rather than the other states?
Yeah, good question. Well, what I expect, I'm going to put the exact locations aside because we could talk about very specific ones and a lot of them. But what I'll say, just macro high level, is that if we have a recession, what you'd expect is for vacancy to go up, rents to go down, and you'd expect net operating income profitability for properties to go down, right? Because rents go down, expenses continue to go up typically. And then what happens there is that you have people who are scared. The stock market, if a recession hits, stock market typically crashes. And we're very high multiples right now in the stock market. So that would seem to be a pretty probable scenario at some point in the future, whether it's this year or not. And then you have investors who are scared. When investors are scared, there's less demand for properties, and therefore cap rates or multiples go down, cap rates go up. So what I would expect is that you're going to have a compounded effect of lower profitability along with lower multiple that someone's going to pay for a property. So I do think that there's going to be a second wave down if this all happens in property valuations. And I think that'll just be a general across the board macro type of situation. And that's actually I'm just giving you the normal recession playbook, right? So that's the highest probability scenario for me right now, because I think it's higher probability we'll have a recession than we won't right now.
Sure. Yeah, that makes sense. We have a question from the audience. Is there a particular asset class or asset classes that you favor in the current environment?
Yeah. So first off, I always like giving an example of this, kind of my mindset at the moment. And of course, I'm one person's opinion. But if somebody asked me that question in March of 2008, from a cycle timing perspective, my answer is nothing is a good idea right now, pretty much, right? Because that's very obvious in retrospect. And that's kind of how I feel at the moment, because I'm expecting that second leg down. And so you have to be very, very defensive. That being said, there are a couple of potential options that I would still be comfortable with. So number one would be some type of business investment that doesn't include asset price concern, that I think is still going to do well in a recession. That could be a possibility. There are some of those. Another would be a very defensive play in any type of asset class, whether you're buying it at a particularly low price, so you're actually reducing some of the decreased price risk we talked about, or you're just underwriting so conservatively that you're underwriting for rents to go down, or there's some other unique aspect to it that will be a defensive play going into recession, assuming we're going into recession, which is very hard to find and accomplish across most real estate asset classes. So overall, I would say that barring some very unique situations, I think that if we're looking at March of 2008 as a cycle timing, I'm not trying to say it's the exact same cycle or whatnot, but cycle timing, most people would agree that it's probably not a good idea to invest in most things at that time. And I'm kind of looking at it that way.
I see. So, Jeremy, if I were to elaborate on what you mentioned about regular real estate asset classes that have some sort of unique position. Maybe it's a tax credit, as you and I have seen some of the groups present, or maybe it's just pure core or core plus instead of being a value add, where you're just holding it because you don't want to keep cash and you're holding it in the asset and going flat, more or less. Would that be essentially what you mean by that?
Yeah, well, so I'll give you an example of a real live deal I'm looking at right now. I can't really share too many details because it's confidential, but I'll say it's a multifamily deal in Texas. It's going to be converted to tax abated. It's also a HUD 36-year loan assumption at a below 4% interest rate. So by the
Wow.
time you add the tax abated piece and you remove the taxes, you're literally at a 231 basis point positive leverage, which I have not seen in I don't know how many years, right? So the question is that good enough to mitigate some of the downside risk in rents? Is the fact that half of it's going to be tax abated and income restricted good enough to protect you from rent reductions during a recession? And do you believe strongly enough in the long-term future of that particular market because you have a very long-term HUD loan? And so, but like if you start adding in, so like, you know, it's not just that it's a multifamily and it's not just that it's in the stock market, it's not just that it's tax abated, but it's also, you know, a HUD loan, right?
Yeah.
And it's so once you start adding in all these unique things together, it starts to become something to look at. And I'm still not 100% decided what I'm going to do with it, honestly, but it's very unique, right? You just don't see anything with 230 basis point of positive leverage at the moment. So that might get me over the finish line, but still with my eyes open, knowing that I'm expecting it to get worse before it gets better, potentially even in that, right?
Absolutely, absolutely. Makes perfect sense. Another question from the audience. What informational resources you like to follow to stay up to date on real estate and macro as well as geopolitical trends? I know there are many, so mostly interested in the ones that you prefer to follow.
Yeah. Well, the thing is, I read like literally 2 to 3 hours a day, typically of you know macro news and real estate news and stuff. So I look at a lot of different things. If I had to choose one, I would say that I like looking at Zero Hedge, which I would tell people to ignore 75% of the articles. There's a lot of conspiracy theory stuff, but these are ex Wall Street guys that launched that website in 2009 in response to like trying to help people understand what's really going on and getting out of the weeds of the media. And they're very, very smart and very good at it. So if you just look at macro data, you just look at them, you know, slicing and dicing that can be very, very helpful if I had to choose one. I always look at CNBC for mass media, like general consumer sentiment and what average people are looking at. Calculatedriskblog.com is very good if you just want to look at straight economic data every day that's charted out and graphed from the past. So you can just look at it on your own with a little bit of commentary, but not too much. But I get a lot of different sources fed to me. I honestly look through a lot of stuff through Google Feeds, which is kind of optimized what I look at over time. So I get all kinds of different sources and try and piece it all together.
Got it. Got it. I am surprised you haven't come up with your own. I would expect you would come up with your own source based on all that information.
Yeah, I don't have time for it, honestly. Yeah, it's an interesting thing to think about, but I'm just so busy.
Yeah,
So
sure, I realize that, but as a former tech guy, someone who uses all of the advanced technology, I'm sure something like that would probably be on your plate down the road.
never know, I guess.
You never know. True. Okay. Next question from Kathy. And folks, feel free to unmute yourself. You're more than welcome to post your questions, but you're more than welcome to unmute and ask. So Kathy is asking, what are some signals that inform you that market finished resetting?
Yeah, great question. If I had to choose one, it would be positive leverage, and it would be my target will typically be hopefully 125 to 150 basis points or more positive leverage. Right now, I've seen the odd deal like the one I mentioned before with positive leverage. The only other deal I've seen with positive leverage was kind of a class B or B minus property in kind of a B minus market. And it was 150 basis points of positive leverage based on a loan assumption. But that's really, really rare still. Yeah, the average deal I'm seeing, most deals are either negative leverage deal or kind of neutral or slightly positive. To me, positive leverage is telling us how much reward are you getting for the risk premium associated with that risk. And essentially, until we get back to like getting the correct amount of reward for the amount of risk we're taking, you know, you haven't had the full reset. So that's the number one thing I'll be looking at.
Yeah, Jeremy, just in case someone in our audience that will be listening later now is not familiar with positive leverage, do you mind just going into a little bit of explanation with positive
Sure,
leverage?
yeah. Sure. So positive leverage, so essentially to try to keep it simple. So let's assume that just equity and debt, there's no preferred equity or a second position loan or anything, right? So typically, let's just say you're going to be 70% loan and 30% equity. Your equity coming in, you want the property to have a total return that's higher than the leverage. Because if you take out a loan against the majority, like a majority loan against the equity, and you're paying a higher interest rate than the profit it's producing, you're getting dragged down by the loan. It's negative leverage, meaning your loan is actually hurting you to an extent based off the profitability of the property, right? And so the way you can calculate that is all you have to do is take a look at the in-place cap rate that is being purchased, the property is being purchased at, and you have to, when you do that, you have to make sure that you're getting adjusted expenses, so not what the seller is necessarily putting in, but what realistic expenses are from the current sponsor who is going to operate it. You want to make sure that the sponsor has taken time to do due diligence and vet the revenues and make sure they're real. And then you're going to come up with a cap rate. And then you're going to have to take a look at, assuming you have a fixed rate interest rate, you got to take a look at the interest rate. And when I say that there's 231 basis points of positive leverage in that deal I was looking at, that means that if the interest rate is 5%, that the cap rate is 7.31%. It's a positive spread in that the cash flow is providing is 231 basis points or 2.31% higher than the actual loan interest rate. Did you think I explained that okay, or do you have any questions on that?
Uh, Jennifer is shaking her head as yes, I think. Sounds like, yeah, I mean, I totally get it. Looks like everyone's okay. I don't hear any follow-up questions, but by any means. Okay, I'm gonna go back to my question list, and folks, again, feel free to unmute if you have any follow-up questions or just brand new questions. Oh, here's one from Dave. Have you heard at LFI conference speak about negotiating changes to the PPM? What changes to the PPM are we as individual LP most likely to get? Any low-hanging fruit?
Yeah, so and actually I'm sorry for any confusion. So I review the PPM and the operating agreement, and sometimes the operating agreement's in the PPM, but it's the operating agreement that I'm referring to. You don't typically negotiate changes in the PPM because the PPM is just summarizing the business plan and some risks and some fee disclosures here, and there's really nothing to negotiate there. On the operating agreement side, I think the low-hanging fruit of the stuff that you probably have a better chance of getting negotiated would be stuff like either reporting requirements, cash call provisions. If you find them very, very unfair, or it's something you should certainly pay attention to, cash distribution requirements. And so I'll give you some easy examples. Let's say that the sponsor has put in writing to you that you're going to get quarterly reports within 60 days of the close of each quarter. Pretty reasonable. But you don't find it in the operating agreement. So that means they legally don't have to provide it for you, right? Even if they can put you can have, they can tell you in writing that they're going to give it to you one day after the close of the quarter. But when you sign the legal documents, you're signing an agreement that you're agreeing to the fact that there are no requirements. There are certain things where, like, you'll turn to the sponsor and say, hey, you told me that I'm going to get a reporting within 60 days of the quarter, but that's not in the legal documents. So as soon as I agree to go in, you're not legally required to provide it. Can you put it into the operating agreement just so that we're on the same page? And honestly, a lot of the time what happens is that the sponsor isn't reading every single word of their operating agreement. They're depending on their attorneys to actually review that for them, which I don't agree with, but that's what really happens. And so they'll say, oh, I thought it was in there already, right? Because they're actually really meaning to give it to you in that time. So there are certain things you can have put in there to protect yourself legally. And I like to put in as much as possible that they're intending to provide, because in the end of the day, it's like an ace in the hole, in that if you ever need to use it, you'll have it in your back pocket from a legal perspective that they breached the operating agreement, right? And that's why it's important to try to ask for some of those things. Indemnification clauses are very important, because let's just say that, if you take a look, typically the manager is indemnified, and sometimes there's exceptions for fraud, mismanagement, willful misconduct. These three words are the most common ones that I see. Some attorneys don't like to put mismanagement. Why? Because that's very subjective. And in court, you can argue what mismanagement and then potentially win with the right judge, right? But if you get that in there, then you actually may have an ace in your hole, for example. Sometimes you won't find any exceptions. And frankly, I'm not okay with that, because they're being indemnified for any acts that they have by the operating agreement, and that's not okay, because if there is fraud or willful misconduct, which is the two most common that the attorneys are comfortable with, because those are actually legal terms, right? That they can be proven or disproven more easily. Why would someone be worried about not being identified if they have fraud? Well, I don't know. I mean, maybe it's someone who's hoping to commit fraud, right? And so I'm not saying that's the case, but it's important to push back on some things that I would consider to be very important and also somewhat low-hanging fruit. I think any reasonable sponsor that hears that you want to add fraud in probably won't say no. And if they do, you have to question as to why that would be, right? So there's certain things you look for that are low-hanging fruit, and it's a combination of low-hanging fruit, but also what's really the most critical to have in there.
Yeah, absolutely.
One more thing I just want to add for everybody in case it's helpful. It's not so easy to necessarily impact changes on the cash call provisions, but I've been doing it for many years, and it's, I think now it's kind of come home to roost with some people who've been in some challenging opportunities recently. I'll just tell everybody what I normally try to negotiate. Because cash call provisions, you should read them, even if you can't negotiate them, you have to read them very carefully. I've seen some crazy ones that are just very, very difficult to meet and very impactful in a negative way if you don't meet the cash call. And that's something you really need to think hard about. I've passed on operators who've had cash call provisions they won't change. Most recently, even just a few months ago. And so normally what I try to do is that if they have to do a cash call, I like to have them be required to do it in this order, in this exact order, which would be they would try to raise internal debt first, and then external debt, and then internal equity and external equity. And what I mean by that is I don't want to get diluted. So the first two steps are debt, where there's a loan ahead of me, and hopefully they specify a maximum interest rate. And the first people that should be offered that debt is the internal investors. Like, you should be able to benefit by providing that if possible compared to an external person, right? But if nobody provides that, let's go for the external debt first so that we don't get diluted right away, right? That would actually prevent them from taking on pref equity, for example, and wiping out the common equity as the next potential step, if they can find it. And then if that doesn't work, you go into internal equity first, right? So people should have the ability to put in equity ahead of anyone else who's putting in equity, whether it's common equity or pref equity, in my opinion, if they're going to potentially get diluted. And the last bastion is the outside equity, including pref equity, obviously. But having those steps in there reduces your risk of getting diluted in the long term and seems pretty reasonable. And often there's no cash call provisions at all. And again, it's one of those things that the sponsors won't necessarily even know, right? Sometimes it's purposeful because they want to have the most flexibility to do whatever they want, right? And that's not necessarily the best thing for the investors. Sometimes they literally just had no idea that there was nothing in there, or they thought something was in there and it wasn't. And so that's why it's always good to ask about changes to the operating agreement, even if you think you're not going to get them, because sometimes it turns out to be as simple as sponsor didn't know it wasn't in there and they're happy to put it in because they just didn't read the document.
That's very true. Yeah, thank you for that, Jeremy. So with all the turmoil that's going on and the unpredictability that we're expecting in the second half of the year, do you think there is a lot more capital sitting on the sidelines now than in the past?
Yeah, so there is some people who believe that because we had so much stimulus money that there's a ton of capital sitting on the sidelines. And then there's some people like me who believe that this is no different than any other cycle, and there's always a lot of money sitting around at the end of a cycle until there isn't. And the reason why there still is potentially is because we haven't had a full reset. So, my response to that is the only way to know if we really have a lot of capital sitting on the sidelines is to go through the full reset, get through a recession, and then let's talk about how much money is chasing deals after everyone's been scared by a stock market crash and additional reduction in asset prices in real estate. And then we'll see. There may be more equity than normal sitting around because of stimulus, and a lot of it may just disappear. If you look at what you would normally expect after the end of a recession, you normally expect the capital to disappear. And so that's what I'm expecting because I go with the probabilities.
Well, if it's sitting on the sidelines now, why would it disappear unless it's already in the equity and it would be wiped out with that equity?
It would absolutely disappear because people get scared, right? You'll have individual investors who will see their stock market portfolios go down 10, 20, 30, 40%. That's just typical for a correction or crash at the end of a recession. And then they're not going to want to invest in anything, right? And so it'll just be in cash or in treasuries. That's a normal response. You'll have institutional investors who will have all this money in the sidelines, and their investors are going to start pulling capital because they get scared, and they're going to have to redeem the capital, and that capital is going to reduce. So this is again what I call the recession playbook. This is just what normally happens.
Right. I don't remember who wrote it, but I was reading statistics in someone's post on LinkedIn Investing. Maybe you remember seeing that someone mentioned that Berkshire Hathaway is holding the most amount of cash right now this year than they ever have. So if that's the case, then
Yes, and
potentially
that's
be in that
yeah, and
environment.
that's yeah, the reason why that's taking place because Warren Buffett being very conservative, his indicator that he looks at on the stock market is extremely overvalued right now, and he's waiting. That's what he's doing. He's just waiting for the cycle to reset. I want to give you actually one data point right now. So if you take a look at multifamily development, there's a very big argument, positive argument to be made that if you start a development today and you deliver the property in 2 or 3 years, you'll have very little competition to actually deliver units into because all the multifamily development is stopped. And you're also probably going to be out of a recession at that point if we have one. So that's really good timing. But why is it that there's very little development right now? It's a combination of high interest rates, hard to get a loan, but all the capital's gone. Everyone's scared. All the
Yeah.
capital's already gone from development. So that's exactly the point of like, that's the first capital that's going to be gone, when we have this type of distress. And so opportunity is there, capital isn't there.
So let's talk about opportunities, Jeremy, because even though we might be approaching recession, we still are in a time where there could be opportunities. And like you mentioned, the one earlier where there were multiple factors that were positive and making that opportunity attractive for other people, such as tax benefits, and potential low loan rate and so forth. So if investors are looking to invest right now, what are some of the things they should do, or what are some of the things or investments they should avoid in 2024?
Yeah. So if you take a look at what happens when a cycle resets, you're going to kind of have opportunity come up in in the order of like two different types, right? So the first one that comes up is distress. And the second one that comes up after everything's been reset is practically anything purchased at a better price, right? So those are two opportunities. So I would argue that number two is definitely not there at all yet, right? Which is why I'm on the sidelines. I would also argue it's too early for number one, right? So again, it's March 2008. Should you be buying distress? Maybe not yet. It's still early, right? So the loan to value you're going to get today may be wiped out next year. And I actually saw this happen a lot in 2009. I saw people go bankrupt because they went in too early on trying to take over distress and stuff. And so I do think there's going to be a lot of opportunity in distress in various forms, but I still think it's too early in 2024, possibly in the second half of the year, depending on what happens and whether we have a recession and other things that happen. But I would be very careful with this. So the one thing that people, I think, sometimes underestimate is how slow real estate moves. And I always tell people it's much better to be too late than too early in real estate. And it's actually better to be too early than too late in stock market. It's the exact opposite. And so, I take a lot of comfort knowing that I'd rather be too late than too early on anything right now. Right. And that's why I'm very happy to patiently wait and see if we actually have a recession or not, remove that risk. Even if we don't, I've removed the risk. So there's a lot of risk right now. And I think that taking advantage of the distress is still too early. So that's my own opinion. I know there are some distress funds popping up, et cetera, but we haven't seen the second domino fall. And until we do, you haven't reduced that risk, even going into distress.
Yeah, and it may take a while until that second domino will be falling for sure. Another question. Oh, we got a few. So what are your views on ATM and other good cash flowing investments?
Well, I'll give you my specific opinion about ATMs. I'm very biased with ATMs. I've been investing in ATMs since January of 2008, so 16 years now, and been very successful. It's probably my number one most consistently successful investment. So I went through the last recession with my ATMs, and they held up pretty well. And so I am still comfortable investing in ATMs today. They're not for everybody. I wouldn't call them necessarily low risk. You don't really have something that's holding asset value very well. It's a cash flow based business with a depreciating asset like an ATM machine. It definitely has a very nice quick payback of capital, quicker than real estate on average, for example. So it's just different. But I'm still very positive on ATMs, planning on making some more ATM investments this year. The one caveat is that I'm still keeping a very close eye on the central bank digital currency. I think that's the potential number one threat to ATMs going forward. So I'm keeping a close eye on that. So that's my general opinion about ATMs, but I'm very biased because I've just had success with it for so long. You know, there was also a question about anything else, correct?
Yes.
It's a pretty broad question. I think that the anything else category, generally speaking, falls into that my concern about timing. So most other things to me are something just be very careful in. To me, ATMs are a bit of an exception because I don't have to worry about the asset depreciating. It's already going to go to zero almost anyway. So I don't have to worry about that during a downturn. And my opinion is that they'll perform well during a recession based on my experience with it in the past. And that's why I continue to invest. That type of combination is hard to find.
That's very true. And you kind of mentioned upon it, but you're not afraid that tokenization will come our way anytime soon?
So you're talking about tokenization, or are you talking about
Digital currency, essentially.
digital currency? That's central bank digital currency. So yes, I am afraid of that, and I think that's the number one potential threat to ATMs. Interestingly, it may or may not be a threat to ATMs in the US. It depends on how the government decides to roll that out, if it rolls it out. And would it be to replace cash or in parallel with cash? Because it could do either. And so we don't know, honestly, anything about what they may or may not do. Nothing's been officially released. So I'm still waiting to sort that out.
Yeah, I agree with you. While it may potentially be beneficial to issue it as a replacement because our debt is rising, and adding another currency in addition to US dollar is definitely not going to benefit them from that perspective.
Yeah, we'll have to see. It's nobody knows for sure what they're going to do.
Exactly. Okay. Next question. Can you give a range in how much real estate valuation go down in a recession?
Yeah, well, look, each recession is different. Each asset class will be different. So office will go down more than self-storage, which will go down a different amount than mobile home parks, for example. So there's no really good answer to give. And also, there's a very strong correlation between interest rates and how much that'll also adjust, right? So there's a lot of factors. And so we still have to see how things will play out, where interest rates will go, and if we'll have a recession, and so many other factors. Of course, that on top of everything else is also dependent on the exact market and location you're looking at, which really can vary a lot in terms of value and value changes. So I can tell you right now that I avoid cities like Los Angeles, San Francisco, New York, Miami. From an investment perspective, I like all those cities, but from an investment perspective, just because they're highly volatile, that means the prices tend to fluctuate a lot in upturns and downturns. So those markets will have different asset class price changes than, for example, I'm just choosing choose random market in the middle of the country, okay, Midwest or whatnot. So there's no way to really easily answer that question, unfortunately.
Jeremy, do you think at this point the sellers, the commercial real estate sellers, have adjusted their pricing based on where we stand with the economy?
No, I don't believe that, because I don't believe that we have, only because I don't believe we've achieved the typical positive leverage you would expect to get on a typical deal with a decent spread as an investor. And that tells me that the adjustment hasn't fully taken place yet. And that's also because I don't think we're at peak concern, or peak scared, or peak distress, I should say. And that's because we haven't necessarily seen a second domino fall yet.
So in terms of the unforeseen events, basically for someone who is very conservative, is it better to stay out of the real estate investment world completely and just keep the money maybe in a CD because it's 5% right now?
Yeah, so that depends on your philosophy, right? So some people will say, look, I'm very comfortable getting into a 10-year fixed rate loan. I don't care that this property is cash flowing at 4% today. I'm very confident in this market. We're amortizing the loan every year. And in 10 years from now, I think we're going to be in a very safe place. I'll have earned cash flow the whole time, and we're going to pay down the mortgage each year, right? I think there's a very valid argument to that. That's one way to look at it, right? Because there's 1,000 ways to invest. None of them are necessarily wrong. It's whatever is the best fit for you. I personally try to be very careful, kind of like Warren Buffett, on the value and the purchase, because I typically go into something that's stabilized and may or may not have any value add upside. So that means I have to be very careful with the purchase price. So I would prefer to put my money into treasuries like I have right now, 5.3 to 5.4%, 3 to 6 month terms, keep rolling it, and then eventually go in at a better timing. Um, and um, and actually, I'm going to get some tax benefits by going to the treasuries, and I'm also going to have a higher cash flow return than that property for the next year, potentially, or at least the next 6 months. So there's pros and cons. So to me, I think every person has to do what's best for them, and I can kind of see both sides to that equation for sure.
That makes sense. So since we touched upon properties and sellers and buyers are not being on the same page yet, what I'm seeing in projections from some of the operators, they're still underwriting properties for 5 years, putting the 2 to 5% vacancy, very aggressive rent increases and so forth. Are you seeing that too, and do you think that's adjusted for the current environment?
Yeah, so the one thing you typically won't see, to your point, is someone projecting negative rents for the next year. But I think most of us would agree that rents are going down in a lot of markets, and the probability wise, they're going to continue to go down in those markets as well as additional markets, right? And so if you're looking at one of those markets and you see someone increasing rents, the first thing you really need to do is change the pro forma and see what happens when you change the rents, and make sure that you're actually comfortable getting into that deal with what you think may be a more realistic scenario. It's very rare that I see a sponsor adjust negative revenues for a recession. I've seen it once or twice, but it's very, very rare. And so, you have to be very careful with that right now. And I would say you have to be equally careful if you're like looking at a cash call, if you're in a challenging situation, to understand what the projections are associated with that, the vacancies assumption, the rent increase assumption, expense increase assumptions, to see if it makes sense for you to really prevent your dilution and actually put more money in, because that's equally the same problem right now. Are the projections really accurate, or do you believe at least that they're conservative and accurate?
Love it. Awesome. Thank you, Jeremy. That was great. Jeremy, are there any other topics that are important for investors that you think we haven't touched upon that you wanted to bring up?
Yeah, I would say one thing that comes to mind is one of the things that makes it very tricky to invest today is the fact that some sponsors, there's a few things happening with sponsors that are because of distress and because of challenges. The first thing is, I've heard of scenarios where people are raising a distressed fund, right? And you think you're about to invest in great pref equity. And the next thing you know, when you start asking questions that wasn't disclosed, is that the first use of the fund is actually going to be to actually do pref equity in their own deal that they're actually managing, right? This I've actually heard of before. And so you have to be very careful with like the marketing that sounds great. You're going to find distressed property. All of a sudden it's that operator, right? And that sponsor. So that's very dangerous. So that's number one, is if you're going to look at that type of stuff, really make sure you're digging into and understand what you're about to invest in. Number two is, I saw this in the last downturn, and it's going to happen again. If someone has had at least one foreclosure, or may have a foreclosure soon, once you've had at least one foreclosure, interest rate, you can still get loans to new acquisitions at a syndicator, but interest rate's higher. Just like if you had lower credit as an individual, right? Mm-hmm. And so the question is, if the interest rate's higher, should you be investing with that sponsor who has a higher interest rate, meaning a lower return for you, the investor, because of that characteristic, when you can invest with someone else in the exact same property at a higher return for the same level of risk? At that point, you're not getting compensated properly for the risk, right? So that's something to watch out for very carefully, and a question to ask. And another thing too, of course, is, do you want to invest with a sponsor who's undergoing any distress, whether it's a lot or a little, because they may not be able to focus 100% on the asset they're about to acquire with you? And of course, the last one is, it's a fact right now that unfortunately some sponsors who have deals that are going very sideways, especially if it's a large volume, are not able to make distributions to themselves beyond, let's say, asset management distributions for third parties, or their own internal asset management, et cetera. And they may not be able to keep the lights on for their own organization. And so I'm talking about like their admin, their actual head office. And so some of them are launching funds or doing new acquisitions to get the acquisition fees to do that. It's just a fact that that's happening. And so you have to be very careful to understand who you're dealing with and what you're getting into, and whether or not someone is distracted or doing all these other things and distressed, and that's someone you want to make a bet on at this exact timing. I actually think we're going to see some sponsors not be able to maintain their head office. I haven't seen this yet, but they won't be able to maintain their staff. And because they have a lot of distress, they may still be acquiring new stuff. You won't even realize it. Next thing you know, they're bankrupt. Like, we're going to see bankruptcies, right? It's just a question of time. And you're going to be completely shocked. Like, if you invested in that deal and they're bankrupt 3 months later, you're like, what the hell happened? Well, they got weighed down by everything else you weren't aware of because you didn't ask, right? So these are really, really important things to ask. It's a very tricky time to invest right now, with everything going on. So you have to be particularly careful. And you almost have to be what I would call defensive right now in terms of when you're approaching any of these deal you're looking at.
It makes sense. In chess, it's called Sicilian defense. It's defense by offense. So, so on that topic, if we're essentially assuming that this sponsor will be fully transparent with us, but if the sponsor lacks transparency and they have some deals going sideways, are there resources other than Googling it to find out what's going on with their deals and how their projects are progressing?
Yeah. Look, there are third-party reporting companies and analysts who put out estimates of debt coverage ratios and some other metrics that you can look at, especially for some of the floating rate bridge loans that are out there, so you can get a sense of how a property is doing. You have to be careful because sometimes that data is an estimate that's not accurate. But it could give you at least a starting point to see if you find a yellow or red flag to then ask questions. So you do have to be very careful with that right now. And you can get some of those reports, from loan brokers and some other people potentially if you have a relationship with them. If not, I would try to build a relationship with them to see if they might be able to help. It is tricky, and you do have to depend to an extent, on the answers you're getting from the sponsor on that, and actually feel like you can actually trust what they're telling you. Some of it's going to be completely internal. No one else is going to know the reality, and you're going to have to decide if you want to trust them or not.
Very true. Thank you, Jeremy. Another
Oh,
question.
Can I just say one more thing on that?
Please.
Clearly, if someone acquired 20 multifamily properties with bridge loans, preliminary bridge loans in the last 3 years, and didn't have 5-year rate caps on them, right? Clearly, that person has a much higher probability of having distress than someone who bought a bunch of properties that had 10-year fixed rate loans on them, right? Presumably. So you can also approach it with that as a starting point and start to make some assumptions of the probability of them having a problem just from the start, which you can do without any more information than just asking them what they've acquired in the last few years and how they acquired it.
And how are they financing the properties?
Yeah.
Excellent point. Thank you for that. Jennifer's asking, what about the loans coming due on very large multifamily units with the big investors who own them? Will those go on sale? Will they unload them at better deals? Did they say that?
So I think that there's a few different ways that can go, right? So number one is it can end up in foreclosure, and that could end up being in a good deal for the buyer. Number two is it could end up being a short sale, which could end up being a good deal for the buyer. Number three is it could be a loan extension or a loan workout or a loan restructuring or a refinance. So those are all different options, right? So it's really hard to answer that question. It's going to be on a case-by-case basis. And by the way, that's going to fully depend on who the lender was and how much flexibility they have to actually make any changes. So someone like, I'm going to pick out a company I'm actually betting against right now in the stock market, which is Arbor Realty, right? So they were one of the largest lenders on multifamily floating rate bridge loans. And they collateralized with CLOs and sold off some of these loans and packages. They have very little flexibility to negotiate changes, because if something's under a certain debt coverage ratio, they either have to make it up in the loan pool themselves or pull that loan out, deal with it themselves, and put a properly performing loan that conforms to all the requirements back in. So they can't just go say, oh, this is our loan. I'm just going to, your payment's $3,000 now. Okay, make it $2,000. They can't do any of that. They don't have the flexibility, right? And so each lender is in a different position to potentially either help or not help or work things out. So it's a kind of a complicated answer because it depends on a lot of factors.
as my tax professor in college used to say, the answer is it depends.
Oh, that's a typical attorney answer, and I hate that answer, but it's true sometimes. So,
It is very true, but yeah, you know,
yeah.
I remember taking multiple tax accounting classes, and it was always it depends, never black and white. But anyway, folks, any other questions? Feel free to unmute yourself or post. Jeremy, this has been phenomenal so far. Excellent content, and we really appreciate your point of view on some of these deals and on the state of the market. We obviously thought that 2023 was unusual, but 2024 is painting to be even more unusual than 2023.
So let me just say one thing because I didn't invest in any floating rate multifamily bridge loans, okay? But I know that a lot of people did because it was like over 90% of everything I got in the past few years. And the reason why I didn't do that at the time is not just because I don't invest in floating rate deals because I look for predictability. It's because we were at a record long cycle. And I knew that eventually the cycle was going to come to an end. And investing in floating rate anything at the end of a cycle is not a good idea typically. So that's just kind of like high level objective fact, right? There's another high level objective fact we're all facing today, which is the stock market's at very high valuations based on a lot of metrics. We're at the end of a record long cycle and that hasn't collapsed yet, right? So if you're trying to figure out what's going on and where we're heading and everything else, the stock market can last high for a long time. But the reality is that everything's cyclical. And so I was in, like, if we had this conversation 2 or 3 years ago and I was telling people exactly this, and now it's easy to say in retrospect, I'm going to tell you not in retrospect that there is a high probability of a stock market crash because that's what happens at the end of a cycle and the cycle hasn't fully reset yet, right? So just please plan accordingly because it's actually pretty predictable, right? Just how the floating rate deals were somewhat predictable to potentially have a problem just because we were at the end of a cycle. So they were higher risk in terms of being predictably higher risk. I'm going to tell you the same thing of the current situation we're in. And that's going to, if that happens, that's going to change everything in terms of the available liquidity. By the way, not just for equity, but also for debt. Banks are going to get scared. They're going to have to shore up their balance sheets. So when I say that the liquidity gets reined in, it's not just equity, it's also debt to actually get deals done. So again, this is like the recession playbook. So I know the media can make it very difficult to get out of the weeds of the media, but just try to look at everything as high level as possible. And when you do, it becomes a little easier to kind of be able to at least be defensive and be careful with what could be coming up. And of course, what I just said, none of it could potentially play out, but you have to go with the probabilities to protect yourself. So
Jeremy, you bring up an interesting perspective, and with that, we're definitely up for a correction. And yes, I've seen several major stock market players indicating that it's coming. Although, like folks like Michael Burry says that every year that correction is coming, but in general. So if the correction to some degree corresponds with real estate market cycle reset, what is that going to make? Is that going to make more investors sit on the sidelines longer? Are there other potential results of that collapse?
I think that the biggest things that will happen as a result of that would be people getting scared, being less interested in investing. So that reduces liquidity. And that, again, that increases cap rates and reduces the multiples, right? So it gives you better pricing. It also decreases the amount of debt or liquidity as well, right? Because banks have to shore up their balance sheets. All of a sudden, like valuations are lower than they thought. They have to give more reserves. They actually are much more careful with the loans that they originate. They do them at lower loan to values. And so everything gets more challenging from an investor perspective, even if you're in the game. But it gets more challenging in terms of, let's say the sponsor is raising capital, both debt and equity, but it also gets much better from a valuation perspective. And theoretically, when you have lower multiples, higher cap rates, all things being equal, you will have better cash flow and a better value, and you'll have more positive leverage, right?
Yeah.
So, and that's, again, that's just like the typical objective recession playbook.
Will
Yeah.
you say that one more time? That ratio of what you just said?
Yeah, I'm trying to figure out which piece.
That last little segment where you just said, blah, 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 blah.
Yeah, so
you're talking about higher cap rates, right, Jonathan?
yeah, so you get higher cap rates, which means you have lower multiples that people are paying on properties, and that with lower multiples, you have higher cash flow, right, as an investor, because you're paying a lower multiple on the profit that it's generating, so your cash flow is higher, right? And that I'm just assuming like interest rates being straight, sideways, so all else being equal. And so that means you're getting better value. That's kind of what Warren Buffett's waiting for. He's actually waiting to pay a lower multiple on whatever property or whatever businesses he's going to invest in. That's the only thing he's waiting for, right? His multiples are too high right now. It's the same concept.
Yeah, so Jennifer, in real estate, the formula is much simpler. The higher the cap rate, the higher the cash flow. There are no multiples. Multiples are more applicable towards the businesses. When you're trying to buy up the business, you getting them evaluated, and so it's whether it's 2x, 5x, or 7x, and that's what Warren Buffett is waiting for essentially. But real estate investors always favor higher cap rates. The higher the cap rate, the better. But it's been hard to obtain that. Let's see, Kathy posted next question. What are some cash flow investments would you suggest exploring besides ATM funds, bonds, and CDs? Do you invest in that fund? Why or why not?
Yeah, so I would say that unless it's really unique, I don't really, I'm going to go back to my March of 2008, example, like what would you think is a good idea to explore in March of 2008? Probably not much, right? Unless it's really unique. So you have to kind of keep that in mind to protect yourself right now. So that's my answer for that. What was the last part of that question?
Do you invest in that fund?
Oh,
Why
yes.
or why not?
Yeah. So the only debt that look, there's 1,000 ways to invest and none of them are wrong, but the only debt that I typically do is I normally lend hard money to first position loans to house flippers. And I've been doing that consistently since 2009. I literally stopped in March of 2022 when the Fed did its first interest rate hike. And then I was able to get, all the loans exited probably by the fall. And I'm just waiting to get back into that. But the challenge with the debt funds right now, in my opinion, is that if you're going into a debt fund, you're basically lending on a certain loan to value. The problem is that the value V is still high because we haven't had the full reset, or at least higher than it will be potentially in the future, right? And by the way, even if you don't necessarily think we're going to have much of a reset, if you agree that rents are down in many areas and expenses are up, that literally means that you agree that at the same multiple or cap rate, the building's worth less in a year than it is today. And if you're a lender on that building, you're going to end up, that's not normal, right? That's not a normal situation. Normally things are going up in an up economy and an up market. And so to me, it's still a very challenging time to invest on the debt side. And people like it because it's cash flow and people like it because the return's a little higher, but this is the wrong time. The right time. So, it's end of cycle still. So the wrong time to do debt or equity is at the end of a cycle. And the best time to do both of those at the beginning of the cycle. That's the lowest risk because the values have reset, right? And that's why I'm waiting to jump back into the hard money lending at that timing, but we haven't gotten there yet.
Excellent point. Thank you. Guys, any final questions? We're almost at the top of the hour and I want to respect everyone's time, including Jeremy's, and this has been very, very valuable. If anyone has any short final questions, by all means, feel free to ask.
Let me just make a statement actually to everybody. So just building on the debt fund, if somebody brought me a debt fund and said, we're doing first position, 20% loan to value, 12% interest, right? I would say, okay, I'm going to take a look at it, despite what I just said, because it's very unique, right? So there's always unique situations, unique opportunities out there. I don't want anyone to take this away with like, okay, turn off your computer, put away your glasses and come back in a year, right? Like that's not the point of this. The point is just have to be very, very defensive. But there are sometimes unique situations, which is why I'm looking at that tax abated deal, which is why I'm looking at ATMs, right? So the concept is not to do nothing. It's just to be more careful at this timing than other timing. I just want to make sure that's really clear because there are unique situations at any time, and sometimes they can make sense.
Yeah, again, to build up on what Warren Buffett said, to be careful when everyone's greedy and greedy when everyone's careful or running away.
Despite his cash hoard right now that he's hoarding cash, I mean, he will make an investment if it's a crazy great investment for him today. Like he's not waiting a year because he wants to wait a year. He's waiting for the right multiple. But if that comes up and it's unique, he'll do it.
Absolutely. I definitely agree on that for sure. Awesome. Well, Jeremy, this has been fantastic. Thank you so much. Folks, we are recording this, so you will all get the recording as well as everyone else on our distribution list. Thank you again, Jeremy, for a fantastic interview. And to hold you responsible, we'll interview you again a year from now on this day, and we'll ask you the same questions.
Yeah, and I mean, I think the big question will be is A, who got elected clearly, but B, was there a
That will be
recession or
big.
not between now and then, right? I would say though, in closing, that if we haven't had a recession by then you know, I could see it being pushed off until next year because of the elections. But then I think there's a very high probability to happen then. You know, if we don't have a recession, at some point you have to ask yourself, do you believe that recessions no longer exist, right? Because they're cyclical. And so that's why the probability is still very high, whether it's this year or next year that we're going to have one. It's not 100%, but it's still very high. So we'll see what happens.
We'll see what happens, but again, because we're getting closer to the election time, certain environments could be manufactured, and then looking back, we may determine, oh, we were in recession
Yes.
at that time for sure.
Yep.
So
For sure. For sure. We'll have to see what happens.
Yep. Thank you very much, and have a good evening, everyone. Take care. Bye. Thanks, Jeremy.